Hey guys, welcome back to the channel. In today's tutorial, I'm going to be showing you guys a triangular arbitrage strategy. It's not necessarily a triangle arbitrage strategy involving pure Forex. Instead, what I'm trying to accomplish is capturing the spread between a single stock in two different exchanges. The first will be domestic, denominated in USD. So for instance, we'll take Amazon trading in US markets, along with Amazon trading in a different exchange, such as this one trading in the Mexican exchange. Now, I don't have intraday data, so I'll show you how to backtest this using daily data. Since we're using closing prices, all of our assets need to be lined up at the same time, which is not currently implemented in the script, but I just wanted to give you the overall idea of the trade. So essentially, these two stocks need to be trading at the same price. If not, then arbitrage opportunities may arise. Let's take a look at our script to see how we can implement this. Alright, so here in our script, we need three different assets: the exchange rate, the asset denominated in USD, and then the same stock denominated in the international currency. We're going to get data from Yahoo Finance and save them in these variables. The next step will be to merge these together and line them up by business day. So we'll merge all the closes together and we're going to line them up to make sure that we're trading the same day and exclude any holidays listed in the NYSE. We're going to go ahead and fill any NAs and then format the column names to help us distinguish the assets. Next, we're going to add the implied Forex rate by dividing the asset denominated in the foreign currency by the asset in USD. And here we get a preview. So we have our stock listed in USD and then the international version denominated in the foreign currency, the actual exchange rate at that time, and then the implied exchange rate, which again is the asset denominated in the foreign currency divided by the version in USD. Now, if these two differ, there may be an arbitrage opportunity. Now, the next step is to calculate the percentage difference. And I return the point difference between our Forex pairs. And if we plot the percentage difference, we see that for the most part, they do stick around zero as it's supposed to, but we do have some extreme points. We will then formulate a trading strategy based on the percentage difference above 2% and also below negative 2%. Now in the next block, we will test the long side. So we're going to long the USD version when the percentage difference is negative, and we're going to simultaneously short the same asset in the other exchange. And we're going to close our positions when the percentage difference turns positive. Ideally, we should close our positions when the percentage difference converges, but I don't have that data. Now, if we step into this block, the first thing we do is add a signal, which is just a sign of the percentage difference. If the percentage difference is negative, it will return a -1. If it's positive, it will return a +1. We're going to subset all of our cases that return a percentage difference less than -2%. And to extract the returns, we're going to pass in 1 through the number of rows in this subset. We're going to subset that particular instance. We're going to get the pricing after the signal was generated. And we're going to get our exit bar at the very first instance where the signal is the opposite. And then just return the trade results, which is the difference between the stock denominated in USD, the stock denominated in the foreign currency. We need to convert this point difference into USD. So I'm just going to divide that by the actual exchange rate. We're going to add a placeholder for the total return. We're going to return our start and end date, the number of days we held, the starting percentage, and the ending percentage. Once it loops through this and it returns a data frame, we're going to add the net return by just summing the USD return and then the assets return in the international market converted back to USD. So if we take a look at the plot of the cumulative sum of the points, we see that it has generated approximately 30 points trading the long side, and in long USD we get a data frame which is a detailed view. So we have the points in USD, the points in the international currency. If we convert that back to USD, this will be the equivalent. If we sum the third column with the first one, we get our net return in USD, and you can see the start and end date, the number of days we held, the starting percentage, and the ending percentage. There was a total of 21 observations. Now if we take a look at the short side, we're going to do the exact opposite. So when the percentage difference is positive, we're going to short the USD stock and long the international version. We're going to close out our positions when the percentage difference turns negative. So again, we're going to subset those cases, extract the returns. We're going to sum our USD returns. And if we take a look at the plot here, we see that this strategy on the short side has a cumulative point return of approximately 10. So if we were to trade the long and short side, this strategy would have been very good. So in summary, this type of strategy may be best to be implemented intraday, as we need to get the exact prices for all three assets at the very same time. By using daily data, our asset prices do not line up perfectly since the stock listed in the international exchange closes earlier, and for the Forex pair that has a completely different close time than the two assets. But it's a worthy strategy to look into. But with that, guys, this concludes the video. I hope this was useful information. I'll leave a link down in the description area to my Patreon where you can find the script. Please consider subscribing to the channel if you haven't done so already. Thank you so much for watching, and I'll see you guys in the next video.